Hey guys, thank you so much for joining me here on this video. My name is Kirk with Tactical Options Trading, and we make videos just like this all the time where we talk about the stock market and options trading. So today I put a quick video together on why trade put credit spreads versus just buying a long call option. So let's get into it, you guys. So yes, why trade a put credit spread versus just buying a long call? So the short answer is because of theta. So now if you're familiar with options, you know what theta is, but theta is a Greek term that we use in options that measures the rate of decay in the value of an option due to time, all other things being equal. So theta is often referred to as time decay. So when you buy a long call option, you have theta working against you, but when you sell a put credit spread, you have theta working with you. So let's take a look at an example of some profit and loss diagrams of a call option. So here we are looking at a long call option, and you can see here where we're making money, where we're losing money. And I love looking at these profit loss diagrams because it really helps you understand where that stock needs to be in order for us to be profitable. So when we're talking about a long call option, we are talking about a debit in our account. So when we purchased this option, we had a debit, or we had money that was taken out of our account. Now when we're looking at a profit loss diagram here, you can see that this line right here is our zero line. So anything above that zero line is our profit, and then right here as we cross above that zero line, that is our break even point. So let's say, for example, we bought this long call and we paid $2 to purchase this long call option. Now $2 is equal to $200. So let's say we paid $200 to buy this long call option, and we bought the 30 strike. So let's say this strike right here was the 30 strike on this stock, whatever stock that is. So in order for us to break even on this trade, we would need this stock to rise from the $30 strike where we bought it at. Let's say we bought the at the money call option. We would need that stock to rise the amount of our debit, so $2. So we'd need that stock to rise from $30 up to $32 before we even started making money on this trade by expiration. So when we're buying a long call option, that stock has to go one way, and the only way we can make money is going up when we buy a long call option. And not only up just a little bit, it actually has to go up enough that we actually get to the point where we break even in order to make our money back. So when we bought something, in order to get our money back, it actually has to rise enough to get that money back. And then at that point, once we're past that break even point, then we start to make money. All right, let's look at an example in a stock chart here. So I'm going to pull up an example here of Netflix. So let's say Netflix, we're bullish on Netflix. We think Netflix is going to go up, and we wanted to purchase a long call option. So the stock right now is at $369, and that's right up here. So let's say we wanted to buy a long call option because we expected that stock to trade up in the next little while. So let's take a look at the options chain. We come in here we're going to go on the Analyze tab in this one. We come in here to the October series. Let's say we wanted to buy the at the money call. Netflix is pretty expensive, and this is another reason I like selling put credit spreads, because it helps offset the cost of just going out and straight out buying a call option. So when we're looking at buying a call option here on Netflix, we're going to buy at the ask. So we'd come in here and we'd click that $25 ask. We'd click that to buy, and now you can see that's going to be a debit in our account of $25. And let's look at it on the risk profile. So here's that same risk profile that we were looking at on that previous page, and you can see our strike price right here of $365 strike, which is representative of this inflection in this line right here. And you can see our zero line right here. So we have to be above that zero line before we actually start making money. So you can see that this green line that you see right here, this is expiration day. This is where the stock needs to be on expiration day for us to make a profit. So we could see that as this stock moves forward, we'd have to have it move up at least to our break-even point, which is this little red hashtag right here, this little red hash mark. It has to rise above that before we make any money at all on just buying a long call option. So you can see that hash mark is right around let's say about $300 $390. So looking back at that stock chart, we would need this stock to rise to a point of $390 right up here at this point before we actually even started making money. And this would have to be by October expiration, which is October 19th. So if we come out here and we find that October 19th expiration, we're looking at about right here. So we'd need this stock to trade in this range and be above this line before we get to our October expiration in order for us to even make money. So that's a long way for that stock to even climb before we can even start making money by expiration. Now let's take a look at some examples of put credit spreads. So what happens when we buy a put credit spread? Well, when we buy a put, or I'm sorry, when we sell a put credit spread, we are receiving a credit into our account. So anytime we talk about a credit spread, that means we have received money into our account. So let's say, again, we're looking at the same thing. We're going to have a credit in our account. Let's say that credit, let's say we received a credit of $3 on this trade. Well, in order for this stock, in order for us to make money on this stock, it would need to stay above our current sold strike price. So let's say, for example, that our current strike price was $50 in this case. Well, all we'd need the stock to do is actually stay above $50 in order for us to keep that same $3. Now, when we're talking about $3, remember in options, that would be $300 if you're trading one contract, because one contract controls 100 shares of that underlying stock. So in order for us to keep that full $300, we would need it to stay above 50. Now, the cool thing is, when we sold this credit spread, we took in a credit, correct? So we took in a credit of $3. So we already have this money into our account. So the stock can actually trade lower than that strike price by just a little bit for us to break even. And that break even point is right here. Now remember, our profit and loss line is right here. And so if we're above that, then we're breaking even, right? So we took in a credit of $3. So if the stock went from 50 all the way down to $47, we would still be breaking even on this trade. So the stock can actually move against us, and we're going to still be okay if we're above that 47. In this case, at expiration, we'd break even. But if we're above that 50, we'd go ahead and be able to keep that whole $3 that we took in on the trade. All right, let's look at now let's take a look now in let me pull my chart up here. There we go. Now we're back up here to Netflix. Let's look at Netflix again. So let's come back in here to Netflix, and we're going to put on a put credit spread. Let's take this call option off here, and we're going to come in here to our options chain, add a simulated trade. Now let's say we wanted, the other cool thing about selling an option or selling a put credit spread is that we can choose our probabilities of success. So let's say, for example, we wanted to pick a 70% probability that the stock, or that strike price in this case, would be out of the money at expiration, because that's where we make the most money. As long as it stays above that strike price, that's where we're going to make our money, right? So let's come over here, and we can see on the right hand side, or right here in our options chain, we have a column that we can add in Thinkorswim called probability of out of the money. You can also do the opposite and do probability of in the money. I like to put probability of out of the money on my chart because it tells me what the probability of that strike price is going to be out of the money. So let's say, for example, we wanted the probabilities to be around 70%. So we could come in here and sell that $335 strike. So we'd go ahead and click that. And then for protection, we'd buy that 330 strike. So we could just come in here and buy that 330. And you could see that on this trade, for this trade, selling the 335 and buying the 330, we would actually receive a credit on this trade of $120 or $1.20. Now let's look at it on a risk profile and see what this looks like. So you can see here that as long as our stock stays above that 330 strike, $335 strike, which is right here, then we make our max profit. And you can see as I roll my cursor over here, that max profit down here on the left hand side bottom corner would be $120. Now let's look at it on the stock chart. So if we come over here to the stock chart, you can see that remember, we sold that 335. We sold the 335 strike, so we're looking at about that 335 strike. That's about right in this area. And we draw a line over here to that 335, and the October expiration that we sold is October 19th, so somewhere in this area. So let's draw a line down here for that October expiration, about right here. So here's the cool thing about a credit spread. Now remember, on the call, when we bought a long call, that stock had to go one way. It had to go straight up, right? The stock had to go actually up a little bit in order for us to even start making a profit. It had to actually come up here around that 390 mark. If you guys remember, it had to be up around that 390 mark for us to even start making money. Well, here's the great thing about a put credit spread. As long as the stock stays above my sold price of $330 or $335 by expiration, then we're going to make the max profit on this trade, which remember was $120, or we sold that for $1.20, so that's $120 credit. So this stock could actually go against us and actually trade down and then go up, and it could even do this all the way down, and we still get to keep that $120. So this is a great thing. So even if you have the stock, you have a bear or a bullish sentiment on this stock, if it's going up or even if it trades down a little bit, you're still good as long as it stays above your $335 strike in this case. So this whole area right in here is if the stock traded anywhere in that area before expiration, we get to keep that full credit. So this is why I like selling put credit spreads or selling call credit spreads. Also, my risk is defined because I bought that protection on that downside. So if the stock actually did trade down below our strike price here and did come down here, I am protected by that long put that I bought at this point. So if it came down to this point, I would actually start making money on that long put, which would actually cap my losses in this case. So the losses are capped by the amount of that spread. So whatever that credit that you took in, that would be your credit, and then the difference between those two strikes plus the credit or minus the credit that you received would be your max loss in this case. All right, so let's get back to our PowerPoint here. So some points to remember when trading credit spreads is they are better suited stocks. They are better suited for stocks that have a high implied volatility, as you can collect more premium for selling the spread. So I got a little typo in there, but they're better suited for stocks that have a high implied volatility because those options are worth more and you could actually sell those for more. So they work better in a high implied volatility market or stocks with high implied volatility. So the stock can trade in a range and you could still potentially be profitable, so as long as they stay above that strike price. And then when selling a spread, your risk is defined versus just selling a naked option. So I would always recommend selling a spread versus just selling a naked position, but versus selling just a naked put or selling a naked call. I would always recommend doing a spread, especially for smaller accounts. If you have a smaller account, you want to make sure you have that that risk is defined. So anyway, guys, I hope you enjoyed that video. I really enjoyed making it. I love credit spreads. If you guys have any questions that I might be able to answer, please comment in that section below and I'll respond to you. And then if you have some ideas for other videos that you'd like to see, also put that in the comment section below. I hope if you're interested in this kind of thing, you'll consider subscribing and clicking that bell so that you don't miss out on any future updates. Thanks so much for watching, you guys. Until next time, keep it in the green. We'll see ya. Bye-bye.